central banks around the world are selling their treasury bonds and buying gold because gold is a neutral asset. It's the old kind of money that we all used to have. An organization called the BRICS countries that is kind of leading the way here. BRICS stands for Brazil, Russia, India, China, and South Africa. And they're forming a separate monetary union that doesn't require the dollar, just totally bypasses the dollar for a lot of kinds of trade, and is threatening to set up a gold-backed currency that those countries will use for trade among themselves. That'll be, backed by gold. Therefore, it will be a sound currency that will hold its value, and it'll allow them to continue to dump their dollars on the open market. So that's, it's a long-term risk to the U.S., but it is a very real risk.
Central banks worldwide are selling treasury bonds and increasing their gold reserves, as gold is seen as a neutral and traditional form of money. The BRICS countries, Brazil, Russia, India, China, and South Africa, are leading this trend by working on a monetary union that bypasses the US dollar for trade. They are reportedly planning to introduce a gold-backed currency for trade among themselves, which would be stable and maintain its value. This move could allow them to reduce their reliance on the dollar, posing a long-term risk to the US economy. John Rubino, a financial analyst, author and commentator, explains that Americans need to prepare for an impending dollar crisis. Central banks are increasingly purchasing gold, with India seeing a significant rise in silver imports, and China encouraging citizens to buy gold. In the first quarter alone, central banks added 290 metric tons to global reserves, marking the largest first-quarter increase since 2000. Globally, many nations are reducing their reliance on the US dollar for trade, such as using China's yuan for oil transactions. John Rubino highlights a potential gold-backed currency among BRICS countries could further facilitate this shift. Interestingly, foreign investors may still buy US assets like real estate, as these assets are likely to retain value even if the dollar weakens, making the US a relatively safe investment destination. The World Gold Council also reported that nearly 30% of central banks plan to increase their gold holdings further over the next year. John Rubino tells about deflationary recession, that equities and real estate may drop, but the Federal Reserve could counter with inflationary measures, leading to rising inflation. US property, especially in border or coastal cities, might not fully offset dollar depreciation, but will retain some value. Additionally, professional investors in North America have also increased their gold allocations, viewing it as an effective hedge against inflation and a means to diversify their portfolios. Gold has performed well this year, with prices rising nearly 13%, making it one of the best-performing assets of 2024. Before we show clips from John's interview, make sure to subscribe and turn on notifications. Only about 10% of viewers have subscribed, so we need your support to reach our goal. Don't miss out. Subscribe first, then enjoy the video.
American has to prep against the dollar crisis that's kind of inevitable now. And one of the things that they're already doing is buying a lot of gold. Central banks are aggressive buyers of gold right now, much more so than any time in the past. India, so far this year, their silver imports are 8 times higher than in 2023. So they're doing that one thing. They're bringing in a lot of precious metals that whatever they do with them, they will tend to hold their value and they'll be a source of wealth. China is encouraging its citizens to buy gold. In, I think it's Korea, you can buy gold in vending machines in convenience stores. So a lot of the world is already doing that particular thing. And then weaning themselves off dollars for trade is another thing that's pretty obvious. If you're selling oil to China, then you take yuan instead of demanding dollars via an intermediate step now. Of course, that's not ideal, which is why there might be a gold-backed currency at some point that the BRICS countries use, so they don't have to trust the currencies of the dictatorships or who are the main members of the BRICS coalition. But if you're in another country, weaning yourself off the need for dollars is a very quick, very simple way to protect yourself partially from what's coming. And you see it happening all around the world. So, and here's what's interesting though, or one of the interesting things is that doesn't mean US assets will fall in value. So it's possible that weaning yourself off the dollar might involve buying US assets because if the dollar, because they will go up in dollar terms, and that protects you against a devaluation of the dollar. So, if you buy a San Francisco condo or something like that, if you're in Japan or China, it's an understandable asset that you own. It's not anything that you really have to go out of your way to figure out. You know how that works. So you just buy it, you leave it empty, and then you know that 10 years from now you're going to come back to it and it's going to have some value. It won't just evaporate. It may go down in real terms, in dollar terms, but it's still going to be a valuable asset with utility. And the U.S. is the least likely country to be invaded and blow up your condo. That's least likely to happen in the U.S. than anywhere else.
Oh,
So it makes sense. So in a weird kind of way, what's happening with the dollar actually attracts capital from the rest of the world. That we have to have a recession because consumers are out of money, everything's too expensive, consumer spending will go down, the economy will slow down, we'll have a recession, we'll have an equities bear market, all of that will happen. And it'll take real estate down with it. But coming out of that, the Fed will try to inflate its way out of the recession, and then we get even more inflation. And in that case, yeah, a house or a condo in a border city or a coastal city in the U.S. may not keep up with the depreciation of the dollar, but it will hold some of its value. Well, if you're trying to get your money out of Russia right now or Brazil or someplace like that, protecting some of your money is better than losing all of your money. Basically, what's been driving up the price of a lot of U.S. assets all along, and Canadian assets, by the way, is people around the world who are willing to take 30% loss in real purchasing power in order to protect the other 70%. And they're buying real estate or condos and oil wells and things like that. And that to them is a good deal, because they made so much money.
John Rubino exposes currently, many U.S. dollars are circulating abroad, but if they return to the U.S., the money supply would increase, leading to higher prices as more dollars chase the same amount of goods. Currently, about half of all U.S. currency circulates outside the U.S., where it serves as a de facto reserve currency for many nations. However, in 2022, the use of U.S. dollars in global reserves has remained dominant, accounting for about 58% of disclosed foreign reserves. However, this figure has declined from 71% in 2000. John Rubino explains the current crisis is worse than 2008 due to the much larger debt burden. Renowned economist Peter Schiff suggests that runaway inflation, combined with a weakening U.S. dollar, might lead to a significant financial upheaval, making treasury bonds akin to the subprime mortgages that triggered the last recession. Inflation would devalue the dollar, making debt easier to manage but impoverishing those who hold savings. Alternatively, a monetary reset could happen, pegging the dollar to gold and limiting the money supply. However, both paths involve significant economic pain and political unrest. Let's dive into the interview.
Right now, those dollars aren't here. They're not here trying to buy a lot of U.S. stuff. But if they come back here, it increases the money supply in the U.S., which, like you said, more dollars chasing the same number of things, and that'll push the prices up. So yeah, that's and that's very probably a process that's in train right now and will continue. And the COVID thing is also really important because most adults in the U.S. had never experienced real inflation before. 2 or 3% inflation a year is beneath notice because there was inflation, but it was flowing into financial assets like houses and stocks, which aren't considered inflation in the U.S. That's considered to be a good thing instead of a bad thing. But in 2022, all that money we created to manage the pandemic lockdowns flowed into everything. It flowed into food and it flowed into rent. And all of a sudden, regular people got to experience double-digit inflation. They saw their living standard rise by about 30% in a lot of cases. It's definitely worse than 2008 because the numbers are so much bigger. We got ourselves out of the Great Recession in that decade by borrowing insane amounts of new money on top of the insane amounts of money that we borrowed before. So because the numbers are much bigger, the consequences have to be much bigger. But the specifics are tough because we're kind of at a choice. We're at a crossroads right now where we have two different kinds of crises. And we can't avoid any crisis, but we have to basically choose now which of these big crises we're going to have. And one, like you said, could be the 1930s. That's where we basically keep money creation under control. We allow interest rates to go up, and that bankrupts a lot of people and causes a lot of the bad debt to blow up. And so we have a deflationary depression in which the debt is wiped out by default. In other words, lots of people go bankrupt. Their debt ceases to exist. They're impoverished. Their families are impoverished. And we have this brutal decade in which 90% of the population feels as poor as they've ever felt and as hopeless as they've ever felt. So we have that. Or we try to inflate our way out of this, which is what a lot of economists seem to want to do now, where we just create as much new money as it takes to make today's debt less onerous. In other words, if the value of the dollar goes down, the dollars that you have to pay to cover that debt are less expensive, and it's a cheaper process for you to get out from under the debt. That will be a catastrophe. That'll be something like Weimar Germany in 1924, when currency just became worthless. Where you take a suitcase full of it to the grocery store, or you burn it to heat your house or something. And I think that's what we want to do. Or not what we want to do, but those are the choices that our governments are making. Because as you mentioned right at the beginning of this talk, that's the easy way out. It's easy for a politician who's going to retire in 2 years to generate a little extra inflation right now, then retire and leave the consequences, the much more serious consequences, to their successors. So that's what we're doing right now. So I think we have a currency crisis. In other words, we have a time when the dollar loses so much of its value that it ceases to function in the way that a form of money has to function to be valid. And now that could lead to two things. One is, that hyperinflation that I mentioned, the Weimar Germany scenario, in which everybody who trusts the government is impoverished because their life savings just disappears. Or we could have a monetary reset, which is we just get rid of the old system and impose a new one. Like on some Sunday night, the government just announces that from now on, the dollar is it's a name for 1/10,000th of an ounce of gold. And it will be henceforth convertible to gold in any government office anytime you want to. And the money supply is going to be limited to the increase in the amount of gold that the US government has, which is to say that the money supply is going to be basically fixed. So no more inflation going forward, sound money. It's a system that works in the future, but at a cost of, again, impoverishing everybody who trusts the government. If you got a bank account in dollars and they make the dollar worth 1/8 of what it is today in real terms, in purchasing power terms, then you became a lot less rich than you thought you were, or you became dirt poor. And so we have to get through the political unrest that comes from that, because there's no way to do this painlessly. And, I think a lot of people are going to be enraged by that. And so we have to somehow, some way get through the 2 years of incredible political unrest without some kind of a violent revolution for that to work. But if we can make it work, that's the least painful way of getting out from under this. There is no pain-free way, but that way would be one that gives us a viable monetary system going forward.
The global economic landscape is shifting as central banks increase gold reserves and nations explore alternatives to the US dollar, posing long-term challenges for the US economy. With a looming recession and potential inflationary policies from the Federal Reserve, both domestic and foreign investors must navigate uncertainty. Whether the outcome is deflation, inflation, or a monetary reset, significant economic adjustments are on the horizon. How might a gold-backed BRICS currency affect global trade and the US dollar's dominance? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first, and then watch the video, and turn on post notifications for more videos like this. Until next time.